Welcome to This Explainer. Today, we're totally decoding the foundational architecture of computerized accounting systems. We're going to look specifically through the lens of Tally ERP.9 to see exactly how your business data gets structured, stored, and managed right from the ground up. But first, I want to pose a pretty fundamental question to you. How does a computer actually keep thousands of transactions organized? Think about a busy mid-sized operation for a second. You've got hundreds, maybe thousands of raw transactions happening every single week, right? You're constantly buying inventory, selling products, receiving cash, paying utilities, running payroll. It never stops. And before a rigid structural system is put into place, this raw business data is, well, it's absolute chaos. Imagine facing a sudden tax audit with nothing but a disorganized shoebox full of crumpled receipts, or some digital folder stuffed with randomly named invoices and zero relational context. No way. It's just numbers and names floating around. To actually make sense of it all, to turn that absolute noise into actionable business intelligence, the software needs a highly specific, totally unforgiving logical architecture. Okay, let's dive into this. To solve that exact problem of data chaos, these systems rely on two organizational heroes, the ledger and the group. Now, they work super closely together to bring harmony to your balance sheet, but as we unpack this architecture today, you'll see they actually play fundamentally different roles in how your financial reality is recorded. All right, starting at the micro level, defining the ledger. So what is it? A ledger is basically a specific T-shaped account head. In the digital accounting world, its core purpose is to permanently record, classify, and summarize your business transactions. Whenever a business event happens, the financial impact of that event has to land somewhere concrete, right? Well, that somewhere is the ledger. And that whole T-shaped concept? That's actually a holdover from traditional double-entry bookkeeping. It represents the strict division between debits on the left and credits on the right, which guarantees the books always balance. It is absolutely critical to remember that a ledger always relates to a particular entity. We're talking a specific person, a tangible asset, a particular operational expense, or a distinct stream of income. It's incredibly granular, ensuring a permanent digital record so you can pull exact data for, say, a single vendor years down the line. And here is the absolutely crucial architectural rule. In a computerized system like Tally, ledgers literally must be created before making any journal entries. The system absolutely forces discipline here. You simply cannot pass a voucher entry without intentionally setting these specific accounts up first. Why? Because these are the exact accounts you're going to need to debit and credit while you're passing that voucher. If the ledger doesn't exist yet, your transaction literally has nowhere to go. The software will stop you dead in your tracks and make you establish the destination before authorizing the journey of that data. Now get this. Surprisingly, out of the box, Tally provides exactly two predefined ledgers for you. Just two. The cash account and the profit and loss account. That is it, the whole shebang. Every other specific ledger your business needs to function, every individual supplier, every piece of heavy machinery, every regional bank account requires manual intentional creation by you before you can start recording a single transaction against them. This blank slate is by design. It ensures your system is perfectly tailored to your actual day-to-day operations. Okay, let's scale up. Understanding the group. A group is your macro-level umbrella. It's a broader accounting classification whose main job is to consolidate multiple ledger accounts that share a similar fundamental nature. Think of it like a massive bucket collecting dozens or even hundreds of individual ledgers together. And we do this to apply overarching accounting rules, like seamlessly applying a specific regional tax law to an entire group of suppliers all at once. And, maybe most importantly, for generating highly organized reports. I mean, without groups, presenting a balance sheet to your executives would literally mean handing them a 50-page, totally unreadable list of every single vendor and asset you've ever interacted with. Groups consolidate all that noise into clean, single-line items like current liabilities or fixed assets. Now, what's really interesting about this is the massive contrast. While the system only gave us those two default ledgers, it comes with a whopping 28 predefined groups right out of the box. This stark contrast perfectly highlights just how crucial this broader structural framework is to the software. The developers essentially pre-built the architectural skeleton, so you wouldn't have to sit there and guess how to categorize fundamental accounting concepts. If we break those 28 predefined groups down, it really reveals the software's structural priorities. You're getting 15 primary groups and 13 subgroups. But notice the heavy tilt towards the balance sheet here. There are 9 dedicated primary groups for it, compared to just 6 for profit and loss. So why the split? Well, balance sheets inherently require way more complex, distinct structural categorizations. You have to differentiate between various types of capital, loans, assets, and liabilities, much more so than a standard income and expense statement. This robust framework basically ensures your most critical financial statements are perfectly formatted, logically sound, and completely compliant with standard accounting principles from day one.
Moving on to the hierarchy showdown.
Let's juxtapose their functions directly to clear up any lingering confusion. Think of the ledger as your absolute destination, the actual, tangible location where a specific financial transaction is recorded. You record here. The group, meanwhile, is your umbrella. It merely classifies. It's kind of like a folder on your computer desktop, while the ledger is a document inside that folder. You don't write text onto the folder itself, right? You write into the document. In accounting software, you absolutely never record transactions directly to a group. You execute the entry in the destination ledger, and then you rely on the system to automatically organize that data under the classifying group umbrella for your reports. Let's see how this builds into a strict, inescapable hierarchy. Step 1 is the broad group, sitting majestically at the very top of the architecture. Step 2 is the specific ledger, nested directly underneath it. And step 3 is the individual transaction, locked safely inside that ledger. The data flow is always downwards. When you create a new ledger, it must inherently be assigned to a parent group. You cannot, and I mean cannot, have an orphaned ledger floating around outside the hierarchy. Every single transaction rolls up into a ledger, and every single ledger rolls up into a group. Let's lock this in with some real-world accounting examples. And this brilliantly illustrates how the abstract architecture meets daily business logic. If we look at the specific destinations and map them to their overarching umbrellas, it clicks. A furniture account is an individual ledger. It maps perfectly to the fixed assets group because, well, it's a long-term piece of value your business owns. Now, consider a specific supplier account, like Vardhaman Furniture Ltd. This ledger falls under the sundry creditors group. The logic here is vital. They supply us, so we owe them money. If you made a mistake, actually scratch that, if you made a huge mistake and accidentally mapped Vardhaman to sundry debtors, your entire balance sheet flips. It would falsely look like they owe you money, artificially inflating your company's assets. A single misstep in mapping cascades into catastrophic reporting errors. Finally, a specific ledger like your Punjab National Bank account would simply be classified safely under the overarching bank accounts group. Which leaves us with this final thought. The next time you open up your system, take a really close look at how your own data is structured and ask yourself, are your ledgers actually living under the right umbrellas? Because if your specific transaction destinations aren't classified correctly into the proper overarching groups at the top, your reporting will inevitably fall apart at the bottom, totally hiding key financial truths. Getting this architecture right isn't just about software compliance, it's literally the very first true step to mastering your financial data.